The VIX closed at 938 this week, one of the lowest fear readings in years, while the Nasdaq fell 1.36% and a wave of AI and chip stocks quietly repriced double digits. That is not a normal combination. When fear is that low, but stocks are still falling, it usually means the market isn't panicking. It means it's recalculating. The question isn't whether AI is still a real theme. The question is, how much of the last 18 months of chip and software gains were priced on earnings that never actually materialized? And what happens to your portfolio when the market finally starts asking for receipts? Let's start with what's genuinely strange about this week. The macro picture, by almost any conventional measure, was not bad. Fed Governor Williams and Treasury Secretary nominee Warsh both signaled in their public appearances that the current rate environment is not heading toward further hikes. Inflation has been cooperative enough that a hold, not a cut, but a hold, looks locked in for the near term. That is historically the kind of backdrop where risk assets breathe a little easier. And yet the S&P dropped 0.77% and the Nasdaq fell 1.36%. Chip makers sold off broadly. Intuitive Surgical, a company whose robotic surgery business has very little to do with AI data center spend, still dropped 11%. Netflix, down roughly 10%, missed not on current revenue, but on forward guidance. That last detail matters enormously. A guidance miss is the market's least forgiving event, because it means the company itself is lowering its own expectations. Nobody can blame macroeconomic surprise when the company is the one cutting the forecast. What we are watching is a specific and important divergence. The macro environment is doing its job, but the micro layer, the actual earnings forecasts at the company level, is beginning to tighten. This is not a crash. The VIX at 938 tells you that. This is something more methodical, a repricing of earnings multiples that were built on growth assumptions that are now being revised downward, one guidance call at a time. Investors who built positions on the thesis that AI infrastructure spend would translate directly and quickly into margin expansion are being asked this week to show their math. The actionable insight here is simple. In this environment, the most dangerous position is not a wrong sector bet. It is an unexamined valuation assumption. Know what earnings multiple you are actually paying, and know what growth rate that multiple requires to be justified. Here is the framing that most coverage got wrong this week. The chip sell-off was described in several outlets as a rotation out of AI. That is imprecise, and it will lead you to the wrong conclusions. What actually happened is more nuanced. The market is not abandoning the AI infrastructure thesis. It is separating companies that have concrete, near-term revenue tied to that thesis from companies that have primarily a narrative tied to it. That distinction sounds obvious when you say it plainly, but it was systematically ignored for the better part of 2025 and early 2026, when correlations within the semiconductor space compressed to the point where a rising tide was genuinely lifting every boat, including boats with no engine. The correction this week began to unwind that compression. Companies with direct hyperscaler exposure and confirmed CapEx commitments from Microsoft, Google, and Amazon in their most recent quarters held up comparatively better. Companies further down the supply chain, or with more speculative AI revenue stories, faced steeper declines. The Intuitive Surgical drop is instructive here precisely because it seems counterintuitive. That stock had been carried partially by the AI-adjacent halo. The idea that robotic surgery and AI-assisted diagnostics are in the same narrative family. When the halo fades, even fundamentally solid businesses get repriced if they had traded above their standalone earnings justification. For investors watching this, the signal is not to exit AI exposure wholesale. The signal is to audit your positions for narrative premium versus earnings premium. Narrative premium evaporates the moment a competitor reports a guidance miss in an adjacent space. Earnings premium is stickier because it's anchored in actual cash flow. Ask yourself, if the words artificial intelligence disappeared from every earnings call tomorrow, would the company you own still trade where it trades? If the answer is no, that gap is your risk. Earnings season continues into next week, and the Netflix and Intuitive Surgical reports have now set a specific psychological benchmark that every subsequent report will be measured against. That benchmark is, did the company not just beat the quarter, but did it guide forward with confidence? Because the market's patience for beaten lower has run out. This is not financial advice. What follows is analytical framing, not a recommendation to buy or sell anything. Here's how to think about the next 3 weeks of earnings in the context of what just happened. First, watch guidance language around AI-related revenue more closely than the headline EPS number. Companies have had roughly 18 months to convert AI infrastructure investment into recognizable revenue lines. The ones that can now point to specific quantified AI revenue, not just AI-adjacent efficiency gains, will be separated from those still describing AI as a future opportunity. The former will be rewarded, the latter will be punished in this environment. Second, the VIX at 938 creates an interesting asymmetry. Hedging is cheap right now. If you have concentrated exposure to names that are reporting in the next 3 weeks, and you have not looked at the cost of basic protection, this week's calm is actually the window to examine that. Low volatility doesn't mean low risk. It means the market hasn't priced the risk yet. Third, the Fed hold narrative is supportive, but not a rescue. Rate stability removes one source of downward pressure on multiples, but it does not replace earnings growth. A company that needed falling rates to justify its valuation still has a valuation problem if earnings guidance comes in light. The macro tailwind exists. But micro-earnings reality is now the dominant force in price discovery, and that shift, from rate sensitivity to earnings sensitivity, is the regime change that the rest of 2026 will be navigated inside of. We started by asking why the market was falling while fear was this low. The answer: this isn't panic, it's precision. The market is identifying, company by company, which AI revenue stories have a foundation and which are still a pitch deck. That process has weeks left to run. The question for next week: if the mega cap tech, names that actually own the AI infrastructure, report strong guidance, does this correction reverse, or has something more structural shifted in how this market prices growth? Subscribe so you get that analysis the moment it drops.